All right, guys, welcome back to another Wise Wealth. We're going to continue with the macroeconomics. Today, we're going to be going over banks, also extremely important, and continues on interest rates, what we were talking about yesterday. So, first things first, how do banks work? Well, they accept deposits, they make loans, they provide services to their clients, they create money, and they earn money. Now, let's go over the first one, accepting deposits. So, I'm sure you've deposited money into a bank before, either whether a bank account or you just went in cash, you deposited a check, whatever it is. But they accept people's deposits. And people deposit the money into a bank to store their money because when you put it into a regulated bank, it's FDIC insured or Federal Deposit Insurance Corporation, FDIC insured up to $250,000, which means if the bank goes bankrupt, you're insured up to $250,000. Now, they also put money to a bank because whether you're just holding like paper cash, when you put money to a bank, usually you're going to earn an interest rate on your savings account, depending on which bank you use, what account you use. It varies, but people deposit money to a bank to store their money for safety and to earn interest over time. Now, like I said, you could have various accounts. You could have a checking account, savings account, CD account, money market account, whatever. And the different accounts do different things. The CD account is essentially it's an account where you put money in and you could choose like a term. So right now I have a 3 month CD account. I put some money into that. I think it's at a 4% APY. So you could put money into that. You could put money into a savings account, which is usually where people just keep their money, just like to save their money. So self-explanatory. And a checking account is usually where people put their money that's going to be spent. Now, checking account doesn't offer any interest. Savings account, depending on what bank you go to, it offers some interest. Right now, my savings account is very low. It's like 0.01% interest, but that's not where most of my money is anyway. I have it diversified. But like I said, these different accounts do different things and offer different rates. And the benefit to these accounts is you can link a credit or debit card to your money. So instead of carrying around cold hard cash, you could just, use a credit card and it'll just take it right out of your bank account. Now, banks also make loans, right? So people make deposits and then the bank takes their money and loans it out to other people. So banks are required to keep a certain percentage of the deposit if the in case the customer or lender wants to withdraw, right? This is known as the reserve requirement and it's set by the Federal Reserve of the United States. Then, after the banks minus that reserve requirement, they lend out the rest, known as the excess reserve. Now, banks make money off these loans because people will pay back the loan and interest. For example, a deposit of $10,000 with the required reserve of 20%, how much is the bank going to loan out? Well, if the required reserve is 20%, they have to keep 2K, right? And they're going to lend out the other 8K. Now, the bank's going to make money off the 8K because people are going to be paying back interest. So let's say this. The loans are assets for banks, but liabilities for borrowers. So when you're doing a balance sheet for a bank, generally for any regular person, a loan is going to be a liability, right? Because it's not making you money and you're actually going to be losing money over time paying back the interest. However, for a bank, loans are assets because that's how they make their money, right? If I'm a bank and I lend out my money, I'm going to be getting paid back plus the interest. So it's basically an investment, right? So it's an asset. Loans are asset for banks and liabilities for borrowers. That's very important to know. If you're ever doing a balance sheet for a bank, the loans will be considered assets. Now, how do banks create money? This is probably the most important part of the banking system. When banks lend out the depositor's money, the loan will eventually get deposited back into the banking system. The bank then takes that new money and loans out a fraction of it. This is known as fractional reserve banking. The cycle repeats, so on and so on. For example, you got a deposit of $10,000. The bank's going to keep the reserve requirement. In this case, we're going to start with 20%, and they're going to loan out the 8K. Now, what's going to happen? The 8K is going to be put back into the system one way or another, right? Because you have to pay back the loan to the bank and plus the interest. So they're going to get the loan amount back plus interest. And then what are they going to do with that amount that they just got back? Well, they have to keep their reserve requirement, right? Because it's considered a new deposit. So let's say the reserve requirement of this is going to be $1,000, and they're going to lend out the other $7,000. Then the $7,000 is going to get deposited back, and the cycle repeats and repeats. When a loan is given out, it's going to increase the money supply. Now, I think I might make another video on this, but the money supply is how much money is circulated within the US or the world. And there's various levels. But the thing to know here is that M1 is the highest tier of the money supply, most liquid, and it's cash and checkable deposits. Now, this whole system is known as fractional reserve banking, and essentially it's what runs our country, to be honest with you. Now, how does the bank make money? Well, as we said before, they earn money based off the interest that's being paid back on loans. So a loan for $10,000 at a 5% annual percentage rate, how much are they going to be getting paid back? Well, if it's 5% of 10K, they're going to be paid back $500 plus the original amount of the loan. So the bank's going to make $500 on this loan. Now you're saying, well, a big ass bank like JP Morgan and Chase, well, $500 is probably nothing to them. Yeah, you're right. Because it seems like a small amount, but banks are dealing with hundreds of thousands of clients and hundreds of billions of dollars each day. So obviously it's a very lucrative business. Now, the other thing that banks do is they provide services to their clients, right? They offer services to either businesses, other financial institutions maybe, or retail customers. Now, what are some of these services? Well, there might be an advised investment. You could have a high yield savings account, CD account, money market account. Safety deposit boxes are a big one. I know people put their jewelry or like maybe a crypto wallet or whatever it is, whatever you want to keep safe, you could give it to a bank and they could put it in a safety deposit box that's only going to be allowed to be accessed by you. They might offer financial advising to companies, to even like a personal financial advisor to, if you want to hire one, you probably could. Might offer like accounting services. But there's also a list of services that they provide. Now, obviously, there's going to be multiple types of banks. The first bank we have is retail banks, which are your average Capital One bank. You could go there, deposit money, take out money, get a loan, whatever. And they offer services to like the general public, like people like you and me. And you could offer checking, savings account, probably CD accounts, money market accounts, whatever. And they provide small loans. Now, when I say small loan, I mean like a loan on a house or a car. Now, yes, these are probably big loans for me and you. A house, right? Like say a $500,000 loan on a house, that's a substantial amount of money. But compared to how much money is being circulated in the business and finance world, that's a very small loan. Now they can offer investment devices such as a CD account, like I just said, a money market account, uh, treasury bonds, whatever. And the second type of bank we have is commercial banks. Now these are what deal with the business clients, right? They offer credit services and cash management services, and they deal with the corporate world. The last type of bank we have is investment banks. I'm sure you guys have all heard of investment banking. It's very tedious, very hard to get into, extremely difficult. Pays extremely well though. But basically what they do is they provide corporate clients with complex transactions, such as a mergers and acquisition transaction. If a company wants to buy another company, or if two companies want to merge, they would go to an investment bank to help facilitate that transaction. And they could also work with other financial institutions. So essentially, this is what banks are. They're very important. It's essentially what the world runs on. I'm not gonna lie. But I hope you guys learned something from this video. Stay tuned for the next one. I think the next one we'll do either the Federal Reserve or the money supply. I don't know yet, but stay tuned for it. Thank you guys for watching.